You did everything right. You worked, paid bills, refused bets, ignored crypto, cut out takeout, saved every month. It wasn't money to get rich, it was for emergencies. The car, your mother's medicine, the down payment on the house, the savings that allowed you to sleep at night. Then a beautiful app appeared. Clean. Modern. It said safe. It said protected. It said high yield. It said partner bank. It had a seal, a smiling influencer, and that magic phrase that turns off the fear, insured by the FDIC. You thought, finally, a responsible choice that actually pays something off. Then, one morning, you try to withdraw the money. Denied. Try transferring. Error. The service opens. Automatic reply. And suddenly the money you saved isn't in your pocket. It's not in your account. It's not available. It's stuck between an app, a fintech company, an intermediary, a partner bank, and a spreadsheet that nobody takes responsibility for. If you want to understand the financial traps that most people only discover after they've suffered financial losses, sign up now. Because this story isn't about irresponsible people. It's about ordinary people who trusted what seemed safe. You didn't lose money because you were reckless. You lost because the system made the risk invisible. It has a simple promise: higher income without complications. There's the psychological seal of approval: secure, partner bank, FDIC insured, safe place to save. Okay, brain relaxes. Nobody wants to turn their emergency fund into a criminal investigation. Nobody wants to spend the night asking who has a banking license, who controls the internal ledger, who moves the money, who answers if the app crashes. You just want to keep what you've saved. That's exactly where the illusion works. The problem isn't that millions are stupid. The problem is that the system has learned to appear simple while hiding the real responsibility. The screen shows one thing. The contract says another. The advertising suggests yet another. And when things go wrong, the truth comes out too late. You thought you were choosing a bank. In practice, you might have been choosing an interface. A nice hallway leading to a room you've never seen. Behind it, other companies, other agreements, other rules. This is behavioral economics working against you. You don't need to lie outright. Just structure the experience so that you feel confident before you understand the risk. The button is big. The caveat is small. The gain appears at the top. When you trust someone, they call it adoption. When the money freezes, they call it an operational event. But for those who needed to pay rent, it's not an event. It's panic. But an acronym on the screen doesn't explain who goes bankrupt. When the coverage is valid, or whether the problem is the bank, the app, the intermediary, or the internal registry. Then comes social proof. If millions use it, it must be safe. If it appears on a podcast, it must be legitimate. If a finance influencer put their face there, it seems impossible that it's a scam. But a large crowd isn't an audit. Popularity isn't protection. Then comes the return. 4%. 5%. More than the old bank, and the present screams louder than the future. That's the bias of the now. You see extra dollars this month. You don't see the rare event that could freeze your life. And nobody reads 40 pages of terms because life is already heavy enough. Work, children, rent, health insurance, debt, taxes. The brain avoids complexity. This isn't a moral failing. It's human nature. And companies know this. Finally, optimism arrives. That happens to someone else, to someone who fell for crypto, to someone greedy, not to me, who just wanted better savings. That's where the machine wins. It doesn't need to tell a lie in every sentence. It just needs to pile up signs of trust, hide dependencies, and let you fill in the gaps with hope. The promise appears in bold. The risk appears in legalese. The gain is simple. The loss is a labyrinth. The product didn't need you to understand the risk. It needed you to stop asking questions. And when you stop, the app has achieved what it wanted. Your money has come in. Your doubt has disappeared. Security has become a product. And the most perverse part is this. The system didn't exploit your greed. It exploited your attempt to be responsible. On the screen, it looks like an account. It has a balance statement, account number, interest. You think, my money is here. But behind the screen, the journey can be quite different. First comes you. Then the nice app, which speaks like a bank, looks like a bank, acts like a bank, but may not be a bank. Next comes the Fintech, the company that sells the experience. Then there may be an intermediary, a middleware, that connects fintechs to banks. Only then does the partner bank appear, the one that has a license, regulation, and deposit insurance. And your money isn't always kept in a separate account with your name on it. Often it goes into a joint account called an FBO for benefit of. In simpler terms, a large account where many people's money is mixed together. While an internal ledger shows how much belongs to each person, this book is the ledger. It's the system's memory. If it's correct, everything seems magical. If it's wrong, your balance in the app was just a promise organized by software. Think of it this way. It's like handing over your salary at a hotel reception because they say your room has a safe. Then you find out the safe belongs to another company, the key belongs to a contractor, and the hotel says they only handled the reservation. When everything works, they call it innovation. No lines, no branches, no paper, no managers treating withdrawals as suspicious. But when it breaks, the drama begins. The app says the problem is with the processor. The processor says it depended on the bank. The bank says it only received data. The intermediary says it's going bankrupt. Customer service says to wait. The FAQ says it understands your frustration. Meanwhile, the light has already won. This is the power of diluted responsibility. Each company takes a share of the profit, the brand, the data. But when it comes time to return the money, each one points to the next door. And you're left holding an app that opens, still shows numbers, still looks normal. But normal people don't pay rent. The salary arrives on Friday. The card works at the supermarket. The rent is paid by debit card. Savings are set aside for emergencies. Everything works because millions accept a basic idea. When I need it, I can access it. Now break that idea. Not everyone needs to lose money. It just takes a lot of people asking at the same time, where is my money? This is how fear becomes macroeconomics. A frozen account is a domestic tragedy. 100,000 frozen accounts become news. Millions distrusting apps, partners, and security promises become a real systemic risk because modern money is a chain of trust. Your bank trusts another bank. The app trusts a processor. The processor trusts a ledger. The consumer trusts a word on the screen. Every link seems solid until the day someone asks, who has the legal obligation to pay me? Wall Street understands this and the public feels it in their gut. If trust breaks down, people don't wait for a technical lesson. They withdraw their money, they transfer it. They close their accounts, they send screenshots. And suddenly, a hidden flaw contaminates the perception of the system. A bank run doesn't start when everyone loses money. It starts when everyone wonders who really has it. If you think your emergency fund shouldn't depend on a hidden chain of companies, like this video and comment on where you keep your emergency fund. Because the risk here isn't just a fintech company going bankrupt. The risk is millions realizing that words like insured, protected, and partner might mean less than they seemed. When trust becomes marketing, the system becomes fragile. When fragility remains invisible, it grows. And when it becomes apparent, it's no longer just a customer's problem. It's a problem for everyone who believes the withdraw button will work. Receive protocol. Receive silence. You receive a page saying that the company understands. They understand so much that they don't pay. They understand so much that they forward the request. They understand so much that they ask for patience from those who use cards for food. That's the moral shock. It's not just about money. It's about asymmetry. The rich call it liquidity. The poor call it overdue rent. The investor calls it exposure. The family calls it medicine they can't afford. The company calls it a failure. The worker calls it theft. That's why so many people explode. Everyone feels the same way. If you rob a bank, you go to jail. If you create something that looks like a bank, collect regular money, and hide behind lawyers, maybe you'll become the founder of another startup. This disparity erodes public trust. Those who profited sold innovation. Those who lost received shame. Shame for having believed. Shame for not having realized. Shame for admitting that the money for the house, the doctor, or the car is stuck somewhere no one can explain. But the shame is in the wrong place. It's not about who saved money. It's about who created a labyrinth and called it simplicity. It's up to those who put security in the shop window and responsibility in the drawer. It's the fault of those who treated ordinary people like cheap cashiers. And when the regulator calls this a gray area, the victim doesn't hear gray. They hear debt growing while someone decides that no one is responsible. Who is responsible if the ledger is wrong? These questions seem boring until they become the difference between an approved withdrawal and a frozen life. High returns aren't a scam. Fintech isn't automatic fraud. Traditional banks also charge fees. The point isn't to idolize old banks. It's to stop confusing appearances with security. Emergency funds shouldn't depend on gamification, influencers, pretty buttons, or fine print. The savings that pay for hospital care aren't startup toys. The down payment on a house isn't cheap capital to sell innovation. The money that supports your family shouldn't be turned into beta testing. Before depositing $1 anywhere, find out who the real bank is. Check with the FDIC. Read who keeps the records. Ask what happens if the app disappears. If the answer is smoke, treat it as a risk. The system loves it when you confuse convenience with security. It loves it when you click before asking. It loves it when an official word makes you ignore the chain. If this has changed how you view your short account, comment safe and watch the video on the screen now, because the next trap is harder to see. The most dangerous financial product in America isn't the one that looks risky. It's the one that looks safe enough to make you stop looking closer.